Started with accounting equation. We're going to talk about the accounting equation today. Now, before we get into the accounting equation, I want to explain the structure of these videos. Now, this is really a how-to video, so I really want to get to the point. But sometimes, in order to get to the point, I have to lay a background foundation, like defining certain terms and certain concepts. So, if you already know the terms and concepts, but you just need practice, I would highly recommend that you just go ahead and just two speed or skip past the lecture part of it and just get into the nitty gritty of it. Okay, so I just want to just throw that out there. You don't need to check off or click out automatically and look for a new video. Just simply bypass me talking because some people they need the talking, some people just need the how to. So just skip past that part so that way you can quickly get to it. Again, thank you so much. Please make sure you like, comment, and subscribe. This will really just help other accounting students like yourself. Again, we are going to be looking at financial accounting. So that's your principal accounting one. So let's get into it. Today, we're going to be looking at the accounting equation. If you don't know, my name is Dr. Akin. I've been teaching this for quite some time. And so I'm excited to be a tutor to you virtually. Okay. So let's make sure we interact by just staying in the chat. Put a thumbs up at times periodically. Put I really get it. I understand. I'll probably prompt you to put some things in the chat so we can just keep this conversation going because I will look back and look at it. All right. So let's talk about the accounting equation. The accounting equation, we want to first answer the question why. So, why do we need the accounting equation? Okay, so why the accounting equation? That's what we want to first answer. But before we answer the why, let's just quickly look at the what. Okay, what is the accounting equation? Boom, it's right there. Very simple. The accounting equation is assets equals liabilities plus equity. So it's a formula. It's really a formula. It's a basic formula. It is assets equal liabilities plus equity. Cool. Okay, so why do we need this though? Why is this relevant to us as accountants or students of accounting? So there are three reasons why this is important. Reason number one, put that up here. Reason number one is that it helps to identify accounting transactions. Okay, that's very important. So this accounting equation, it really helps us to identify accounting equations. So in a business, there are going to be multiple types of transactions, right? There are going to be business transactions, there are going to be accounting transactions. We don't really care for business transactions. We only care for accounting transactions. So accounting transactions are transactions that involve assets, liabilities, and equity. If it doesn't involve that, we don't really care for it. Okay. So again, the accounting equation, it helps with that. Number two, you want to write this down or you just want to make this note is that it helps, oops, got my cap lock on. It helps to sort or organize the accounts. Okay. So what we're trying to do with the accounting equation, it helps us to sort or organize transactions. So again, it's going to be a lot of transactions that we have in a month or a year. And this accounting equation, assets equal liability plus equity, is just helping us to sort and sift, right? Very important. Again, if you know all of this or this is not relevant to you, just go ahead and skip this part and we'll get right into the problem of it. Okay. And then number three is that it helps us to communicate to non accounting users. See, you are a non accounting user, right? That's why you're coming to this tutorial because you're trying to learn, you're trying to get this simplistic way of wrapping your mind around accounting. You see? So, this equation, assets equal liability plus equity, it helps us to easily communicate what accounting is all about, right? So, these are the three primary reasons why we need this accounting equation, okay? Now, also, then we need to discuss the parts of the accounting equation, which is assets, liabilities, and equity. Okay, assets, liabilities, and equity. Okay, so what are assets? So let's talk about that briefly. What are assets? You want to write this down, or you just want to make note. Assets are resources a company owns or controls, right? So whatever a company owns or controls, we call that assets. So let's look at you as a company. You know, Kevin Hart, he says, I am the brand, right? Like Kevin Hart, he talks about how him himself, he is the company, he is the brand. So we all are a company in and of itself. So I want you to think of yourself as a company, right? So what are things that you own 100% outright? What are some things that you own 100% outright? Well, you probably own the cash that is in your bank account. It may be a little bit, it may be a lot, but you own some money and it's in a bank account, and that's something that you own. I cannot go to your bank account or your bank and then try to withdraw funds from your account. I can't do that because I don't own the account. You own the account, so it's your asset. Another example would be like clothing. So the clothes that I'm wearing, no one can take me to court and try to sue me for the clothes that I'm wearing because they're absolutely mine. Okay, no one can do that. They're my clothes. It's my asset because I own it and control it 100%. Another example would be like technology. Okay, so you have some technologies like iPhone or Xbox, whatever. It's so interesting. Growing up, we never had an iPhone. Have you ever heard of a sidekick? Go ahead and look that up. Okay, take a Google break and look up a sidekick. I came from the sidekick era. Okay, I came from the flip phone era. Okay, do you even know what a flip phone is? I came from the Nextel era. Okay, I came from the era where you had to click a button and your phone flipped. Okay. But, anyways, I digress. Go look that up. All right. So, you have certain technology that's yours 100%. Your iPhone is yours. Your Android, hopefully, you don't have an Android, but if you do, I'm so sorry. But your Android is your property. I don't know why you would want an Android, but you have an Android. Okay. And then also like an Xbox, gaming system, a computer, right? All of these are things that you own, right? That no one can take from you. So all of these are called assets. Okay. Let me get a thumbs up in the chat if you got it. Get a thumbs up in the chat, or yes, this is making sense, Dr. Akin. Go ahead and put that in the chat so I know that this is making sense. Okay, the next category or the next component of our equation is liabilities. So, what are liabilities? You want to write this down. Resources that a company has possession of, yeah, possession of, but does not own. Okay. So when you think about things that a company owns, okay, but doesn't necessarily have possession of, these are called liabilities. So, what are some examples? Again, I want you to think about your life. Don't think about a company, but just think about your life. What are certain things that you are in possession of, but you don't necessarily own? Let me talk about my life. The first one is a car. Okay, so I have a car. I have a BMW. Your boy is balling. Okay, so I have a BMW. That was so corny, but I have a BMW, and this BMW is mine. I can put rims on it. I can put tents on it. I can put gas in it. I can choose not to put gas in it. I can plug it up for electricity, hybrid, whatever. I can put oil in it, oil change, all these other things. I can do what I want to do with the car that I have. But the moment I stop making payments on that car, Bank of America will quickly repossess my car. Okay, they will quickly repo the car. Okay, that's an example of a liability, something I own, but I'm not in full possess, or something I possess but I don't own. What's another example? You want to write this down? A house. A house is another example. Come on, you talk about generational wealth. They say, hey, buy a home if you want generational wealth. Okay, what they don't tell you is that when you buy a home, although you possess it, meaning that you can cut the grass, you can paint the walls, you can put furniture in there, you can stuff up the walls, you can do whatever you want. The moment you stop making mortgage payments, the moment Wells Fargo will come and take that house, right? Or foreclose your house. So again, a liability is something that I possess but I do not own. All right, so these are examples of liabilities. Then last one, you want to write this down or just make a note. Equity. Okay, equity. So what is equity? Equity are resources that a company has but belongs to the owner. Okay. So resources that a company has but belongs to the owner. So what's an example of that? A big example, and I just want to make it very simple. There are multiple examples, but I want to keep this on a very simple front. Is profit. We know what profits are, right? Profits are when revenue. So when revenue, that's money coming in, okay, is more than expenses. That's money going out. Okay. So when revenue, that's money coming in, is more than money going out, expenses, we make a profit. Now, that profit is the extra money. So think about it like this: the extra money that you may have. That extra money, it doesn't belong to the company, it actually belongs to the owner. Okay. So that's where owners are being paid out of the profit. That's a simplistic way of looking at it. We can dive into some more nuances, but again, the goal is for you to get it and to be good. All right, so cool. So here we got assets, liabilities plus equity. Now that we know this, we're going to treat this like laundry. Okay, so I tell my students all the time, don't view this as a math formula, because I know a lot of people get trippy and get annoyed and are triggered by math. I get triggered by math. So why don't we just look at it as something we do every day? Hopefully you do this every day, which is your laundry. When you think about your laundry, you have a whole bunch of dirty clothes and you're trying to put them into various categories. You see? So I have a whole bunch of dirty clothes and then I begin to separate them. I begin to put my whites over here, trying to get, okay, I put my whites over here. I put my colors over here, and I put my delicates over here. Okay, whites, colors, delicate. Okay, so now I have a whole bunch of nonsense or dirty clothes, and I'm putting them into buckets. That's all we're doing here. We're going to have a whole bunch of, and I'm going to use this as an example, bring this over here, try to make this small so we can see. All right, cool. Make it a little bit bigger. All right, so I have a whole bunch of laundry right here. So these laundry is what we call transactions. So I have a whole bunch of transactions here, and my goal is to literally put them in the right bucket. That's it. That's all you have to do, guys, and it will be as easy as Sunday morning. Okay, literally. You're probably too young for that. Okay. So let's try and do this together. Okay. Let me create some space here. All right, cool. So we're going to take all of these and dump them into all of here. Okay. So pretty straightforward. So let's do that. I'm going to put a column here called the date. So let's start off with the first one. So the first one says on October 1st, right? So on October 1st. So I'm going to come here and put 10-1. Cool. All right. So let me zoom in here so you all can see it. It's very big screen for you all. So yes, let me back up a little bit. All right, cool. So on October 1st, Ray, so this is the owner, he invested $45,000 cash. So this is what I'm going to do. I want you to start highlighting keywords. Okay. There are going to be some keywords here that are going to give you kind of an idea of where you should categorize it. First of all, it's this word invested. Okay. So what is invested? Invested means that we're putting something into something. I'm putting something into something. So if I'm investing time, I'm putting my time into into this video. That's me making an investment into your education. I'm putting my time into your learning. Okay. And then next, so in this case, we're investing. What are we investing? So that's what I want you to be looking for. What are we investing? We're investing, number one, you want to write that down, cash. So we're investing cash. We're also investing computers. And then it looks like we're investing office equipment. You see? So I want you to write that down, right? What is investment? Investment is putting something into something, right? So what are we putting in? We're putting in cash, we're putting in computer equipment, and we're putting office equipment, right? So the question is, what is cash? What is computer systems? And what are office equipment? Do you think they belong in the asset, liability, or equity? So again, what's happening? The owner is putting these things into the business. So that means the business, so we're recording on behalf of the business. That means that the business, okay, is gaining what? They're gaining cash. You would say that cash is an asset because now the business owns the cash. The owner puts it in and the business owns it. Okay. Now, so that we'll put that under cash. What else? Computer system. So we want to write that down. Computer system. Computer system is an asset. You see, why is it an asset? Because the owner is giving the business something. So the business is receiving a computer system. So now the business, it owns it completely. Okay. Next one, office equipment. That's also going to be an asset. Why would office equipment be an asset? Office equipment is an asset because now this equipment, let's say a Mac computer, the owner gives to the business, so the business receives it, so the business owns it 100%. Okay? Give me a thumbs up, thumbs down if you get it. Go ahead, put that in the chat. Thumbs up, thumbs down. Put it in the comments. Thumbs up, thumbs down if you get it. Cool. Now let's do another exercise together. Let's look at 10 or on October 3rd. So right now, don't worry about the money. Don't worry about the math. Let's just focus on doing our laundry. Let's make sure we know what are whites, what are coloreds, and what are delicates. So in this one, it says we purchase, the company purchase. So that's a very important word. So what happens when you purchase something? When you purchase something, you're giving up something. Please watch this. You're giving up something to get something, right? If you were to go to Zara to go buy a sweater, you're going to give up your hard earned dollar to gain a really nice piece of clothing. You're going to give up something to get something, okay? So now let's see what's happening here. It looks like we are purchasing computer supplies. So again, what are we gaining? What is ours? What are we in control of? We are in control of a computer supplies or computer supplies. So computer supplies is going to be an asset. Da, 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 da. Yes, an asset. Okay, cool. Now, this word is very important and you want to take note. This word credit. So the word credit, if I can highlight it rightly, let's see if I can make a comment. Okay. Y'all see? This is why you need to like, comment, and subscribe, okay? Because I can't comment, I can only highlight here, and I can't comment because I don't have the paid version. You see? So that's why y'all need to like, comment, and subscribe. No, I'm kidding. Let's see if I can add a comment. All right, add a comment here. Okay, so now check this out. What is credit? You want to write this down. What is credit? Okay, so in accounting, there are two forms of payment. So whenever you're paying for something, there are two forms. Form number one, let's put form number one is going to be with cash. So you can pay something with cash. So this computer equipment that we just gained, I can pay with it with cash or I can pay with credit. Now, when we say pay with credit, what we're saying is we are in possession of, but someone else controls or owns, right? What does that sound like? Sounds like a liability, right? If you go back to the notes we took earlier, it sounds like a liability. So again, this word credit is very important. What is a credit? It's a form of payment. It's a form of payment. You can either pay with cash or you can pay with credit. A credit is when we are in possession of something but someone else controls. Okay. So now that we have that, let's post that and get rid of it. Okay. So going back to the problem, we purchased computer supplies. So that's something that we own, right? So we're in possession of it. So we can call that an asset because we're in possession of it. But we also have to recognize the fact that someone else controls it. which is a liability. So we call that, I want to write that down, accounts payable. Okay. Whenever you see a credit, it usually refers to, so credit usually equals accounts payable. Okay. So you just learned something. Go ahead and put accounts payable in the chat. Accounts payable. All right, very good. So you see it there. Again, the more we do this, the easier it's going to be. And again, I want to show you some hacks. So please don't skip past this, right? So let's look at another one. The company billed. Okay. So again, that's another keyword that we want to take note of. The company billed Easy Leasing 4,800 for services performed. You want to highlight that in installing a new web server. So what's happening here? So here's a situation where we performed work. Okay, so let's make another comment. Performing. So when we perform work, so let's put when performing work. Okay, so when we perform work in accounting, this is very important. Remember, I said I'm going to be taking notes, but then also trying to teach and also trying to do a how to. So when we're performing work, we are immediately owed the money. Okay. So in accounting, that's very important. So we do not wait to receive the money to say that we are owed the money. That's very important. So, in other words, this is what we're saying, right? Let's say I come and I cut your grass. The moment I cut your grass, that's the moment you owe me the money. Now, I don't care whether or not you pay me because legally you owe me that money. So, say for example, I cut your grass and you don't pay me. It doesn't matter because I know that legally you owe me money. Okay. So if I perform work and you have not paid me, at any given point, I can take you to court and the court will say, yes, you have to pay Dr. Akin for cutting your grass. You see? So whenever we see the word performing work, we usually associate that to revenue. So you want to write that down. Whenever we see the word performing, yes. Whenever we see the word performing, it's messing me up a little bit. Oh, okay. Okay. Forgive me breaking down here. Cool. Perfect. So whenever we see the word so whenever we see services performed, I wanted to get the exact same language. We think revenue. Okay. Revenue. Okay. So that's very important. So here we have a situation where we build. Okay. So what is billing? Okay. So what is billing? Hopefully, you're understanding, you're gaining here. When we say billing, we're talking about expecting to receive money. Think about it. When I bill you for work, I'm expecting to receive money later down the road. It may not be right now, so may not be right now, but it will be someday. Okay. So someday, it doesn't matter. It could be 30 days from now. It could be 40 days from now. It could be 100 days from now. You're going to pay me that money. So, okay. Now check this out. Whenever you see the word billing, again, I'm just trying to put you on game here. Whenever you see the word billing, automatically think accounts receivable. Okay. Accounts receivable is money they owe us on credit. That's all you got to think about. Money they owe us on credit. Remember, what did we say credit is? It's future payment. So money they owe us on credit. So when you think about it, money they owe us, let me put one more thought here. Money they owe us on credit is considered an asset. Okay? Once you think about it, it's considered an asset. Why is it considered an asset? It's considered an asset because we have legal right to the money, even if we currently do not see the money. Okay. So even when we don't see the money up front, that does not necessarily mean that it's not our money. It's our money, although it's not in the bank account, right? It may not be in your bank account, but it's still yours because we have legal right to it. Okay. So now that we did all of that, now that we said all of that, what do you think billing should fall under? Okay. Billing, again, which is also equal to accounts receivable. So we'll call it accounts receivable. Billing is going to fall under assets. So I'm going to put accounts receivable. Again, I'm going to put billing here so you're not confused. Okay. So billing. Cool. So billing is going to go under an asset. Accounts receivable is money they owe us. That's an asset. We own it legally. It's ours. We may not physically see it. It has not physically manifest. That's what y'all say, right? But it's still ours for the grabbing. Okay. So accounts receivable is an asset. Now, remember we said service performed is going to be revenue. So revenue, we want to put that under, very important. We're going to put that under equity. Equity. So revenue falls under equity. Again, what is equity? Equity are resources that a company is in possession of, but it belongs to the owner. You see, although the company is receiving this 4,800, is still owed to the owner. So at any given point, the owner could say, "Hey, I want that 4,800," and the company has to say, "Yep, here you go. Here's that 4,800." Okay. So that was long, but it was good. So let's keep going. Let's keep trucking along because the more we do this, the better we get at this. Okay. So let's move forward. On October 8th, we paid, that's a very important word. Look at that word there, cash for computer equipment or computer supplies that we purchased on October 3rd. Okay? So now what is happening here? This is where it gets a little tricky, right? So it looks like we paid cash. So what is that? We've used that before. It's an asset. Okay? For computer supplies. So what do we put? Computer supplies is an asset, right? So we used that before. It says purchase on credit. So we talked about this already. What is credit? A credit is accounts receivable. So accounts payable. And maybe I haven't put it here, so I just want to put it here. Credit credit, yeah, credit equals accounts payable. Accounts payable is money we owe them on credit. So this is very interesting because accounts receivable is money they owe us. Accounts payable is money we owe them. Okay. So in this situation, and we'll look at this later in the other video, but in this situation, what we're seeing here is that we are paying back a debt. We're paying back a debt. Okay, so we have that here. So we move along. So let's go with October 10th. So October 10th, it says the company hired a part-time assistant. This is very, very critical. This is really good, right? So in this case, this is not, so let's put here, this is not an accounting transaction. Again, I want you to do this. Okay, so this is a mini in-class assignment, right? I want you to put in the comments why this is not an accounting transaction. Based off of what I said when I first started the lecture, why is this not an accounting transaction? Okay, so I'm just going to come and put that in there. Let me see, alignment, let's merge, and we're going to say non-accounting transaction. Okay, I want you, I'm not going to give you the answer. I'll give you the answer in the chat, in the comment section on the YouTube video. Put your answer there and I will reply. I'll try to reply in 24 hours what the answer really is. Okay, you may know it and then I'll say, yes, that's the right answer, or I'll reply with the right answer. But why is that not an accounting transaction based off of the lecture? All right, let's move along. Next one, October 10th, 12th. It says the company billed, again, easy leasing, another 1,400 for services performed. All right, y'all. See how the repetition, this is why I say the more you practice, the better you get at it. So you should be able to do this. Go ahead and put in the chat your answer. Go ahead and pause it. Put in the chat your answer. Literally, this is a copy and paste. Okay, so what's the answer? The answer is, again, we did this before. The word build means expecting. So we're going to put accounts receivable in there, right? Accounts receivable, right? Because that's billing. We talked about this on October 3rd. So what else are we going to put? We're going to put revenue in there, right? Revenue. Okay, so that's it. And you're done. We did this before. Okay, let's move on to October 15th. Okay, October 15th. It says the company received. That's another interesting word. When you receive, so now what are you thinking? Okay, there's something that we are coming into possession of. Something that we're coming into possession of. So the company received 4,800 cash from Easy Leasing as partial payments towards this account. So again, what did we receive? We received cash. Okay, so think about that. Okay, we received cash. So what is happening? Our cash is going to be considered an asset because we receive it, it's ours. Now, what else is happening? We're also receiving revenue here because remember what I said, and I'll put it here, revenue is money coming in. Expenses are money coming, or excuse me, money going out. So you want to remember that. These definitions are critical. Revenue, money coming in. So we receive money, we call that revenue. If we paid, we call that expenses. So in this case, all we're going to do is put cash and revenue. Cool. So we move on. 1017. It says the company, this is perfect. Pause the video and put the answer. The company paid. The company paid, okay, cash to repair its computer equipment. Now, what pay is what? Money going out, right? That's what we said here. Expenses, put that up on the screen. Expenses are money going out. So the company paid cash. So we know that our assets are going to be impacted. What we also know, you want to write this down. This is new. We're going to put expenses here. We're going to put expenses here. Okay. So what are expenses? Money going out. So we pay cash for money going out. So that's all you have to put there. If you have any questions, put it in the chat, y'all. 1020. Let's keep moving. The company, again, we what? Paid. What did we pay? Cash. What did we pay for? Advertising, publishing. So again, cash is going to be impacted and our expenses are going to be impacted, right? Because we're paying something. Money is going out. Okay? You see how it's kind of redundant now. 1022. The company received cash. Okay? We received cash. So what is going to be impacted here? Cash. Again, what is going to be revenue? Because now money is coming in. We received money coming in. See? Getting through it like sliced bread. Okay? You can tell how old I am when I'm using these old references. Okay, build. You see? Build. We build a company for services performed. Again, pause and do the problem. What is build related to? What did we say? Accounts. Yes, you got it. Receivable. Accounts receivable. Okay, so we build. And what do we build for? Work that we perform. What do we call work that we perform? Revenue. See? Very good. Moving along. 1031. It says we paid cash for assistant wages. Okay. So again, we paid, so cash and expenses. How do we know that this is an expense, Dr. Akin? So let's talk a little bit more about expenses. Oops, spelled that all the way wrong. How do we know that they are, what are expenses? Again, it's money going out. Okay, but what are expenses? What are they used for? Okay, anything to keep or maintain the operations of a business. Okay, anything to help keep or maintain the operations of a business. So if you look at it, we need people to work to continue the operations of our business, correct? That's why we call that an expense. If you look on October 20th, we said it's an expense advertisement. Okay, we definitely need to promote our business to keep it operating. You see, October 17th, we paid for computer equipment. We said that was an expense. That makes sense. We need technology to continue to operate our business. So again, expenses are anything to keep or maintain the operations of our business. Got it? Good. All right, let's do the last one. 1031. It says the company paid 3,600 cash in dividends to the owner, sole shareholder. So see what's happening there. We paid cash for, this is a new one. You want to write this down, dividends to the owner. But that's key, to the owner. That's the money though. Because which one of these speak to the owners? Which one of these speak to the owners? Is it assets? It's not assets. Is it liabilities? Not liabilities. Is it equity? Yes, it's equity. Because what is equity again? Resources that the company has, but the owner, it belongs to the owner. Okay. So what are they saying? There's some cash that belongs to their owner. So what is being impacted? Cash. And then the owner is going to receive, you want to write this down, dividends. Okay. What are dividends, Dr. Akin? Glad you asked. Dividends, you want to write this down, are the cash payment made to stockholders, okay? Which then asks the question, who are stockholders, right? Stockholders are people who own a piece of the business. Okay. So people who own a piece of the business are called stockholders. Okay. So stockholders are owners. In other words, let's just put it there to be clear. Stockholders equal owners. Okay. Company pays stockholders. Okay. So when a company pays stockholders, we call that dividends. Okay. Cool. Dividends, again, is when company pays stockholders. You got it. So that's why we put cash and dividends. Okay. So we've gone through all of that. Awesome. Clap for yourself. Now, all we need to do, okay, now that we talked about how to categorize it, there's one more step and we're going to be done with the accounting equation. The last step is now putting dollar amounts to this because remember, this is a formula and it requires numbers. But I walked you through how to categorize it so that's easier, right? So now we just got to really talk about numbers and we're done, y'all, and we're done. Okay, so let's go through these again, now adding numbers to our category. Let's start from, we'll work our way from down to the top. So on October 3rd, the company paid 3,600. So think about it. The company paid 3,600. So that word paid is very important because it lets us to know what direction this asset is going. Is the asset increasing or the asset decreasing? So you're going to hear that a lot. They're going to say increasing or decreasing, right? So the company paid 3,600 cash. So is cash increasing or decreasing? Put it in the chat. Increase or decrease? Put it in the comment section. Please, if you're watching it, put it in the comment section. Don't just watch this, put it in the comment section. Is cash increasing or decreasing? Yes, you got it. Cash is decreasing. So we're going to put a negative 6,000 and negative 6,300. So watch this, you all. If we're putting a negative 3,600 here, then we need to put a negative somewhere here, right? We need to put a negative somewhere here so it can balance, right? Accounting is about one word. It's about one word, balance. Okay. If you balance, then you got the question right. If the accounting equation is not balanced, then you did something wrong. If I put a negative 3,600 here, then guess what? I need to put a negative 3,600 here. You see, negative 3,600 equals negative 3,600, and you're done. Okay, let's move on to the next one. The company paid $875 cash for their employee. So is cash going up or is it going down? Is it increasing or decreasing? You got it. Cash is decreasing here. So we're going to put a negative 875. So what do we need to do on the other side? We need to put a negative 875. And we're done. Moving on to the next one. The company billed this company $5,208 for services performed. So think about it. Okay, we are billing somebody. Is that going to increase our assets, what we own, or is it going to decrease what we own? Go ahead and put that in the chat. Is it going to increase what we own or increase our asset, or is it going to decrease our asset? Yep, you got it. It's going to increase our asset. You want to write that down. Is going to increase our asset, right? Because we're gaining money, right? We're gaining money. So if I put a positive on this side of the equation, go figure, I need to put a positive on the right side of the equation, okay? And that's it. You see, whatever you do on one side, you need to do on the other side. So let's look at another situation. Okay, here's the, where are we at? Forgive me. The 22nd. The company received 1,400 cash from Easy Leasing towards its account. Okay, so we received 1,400 for its account. Now this one is a little tricky. Okay, this one is a little tricky, and the reason why this one is tricky is because this one is actually wrong. So forgive me. Okay, so professors can be wrong, and that's okay. For the 22nd is actually going to be cash, and we're going to come here and put accounts payable. So this is where it gets a little tricky because on October 22nd, it says that we are getting money back from what we expected. So if you look here on, so let's go back to, okay, let me find it. Let me find it. Oh no, we're absolutely, it's okay. We were right. My apologies. Okay, so what are we doing here? Again, we're going to put a positive 1,400, right? Because we're gaining 1,400 here. So cash, we receive cash of 1,400. It says from Easy Leasing towards its account. So here's the thing. Actually, I was right. Okay. We're going to put accounts. Okay, that's what we need to do. So in this problem, we're actually going to insert. So we're actually going to put accounts receivable here. So for October 22nd, here's the situation. We said if you look up here on October 12th, it said that we billed. Again, what is billing? Remember, we said that billing is, do I have it here? Nope. What did we say billing? Okay, it's up here. We said billing, expecting to receive money later down the road. Okay, so if you look on October 12th, we said that we're expecting to receive later down the road for $1,400. Okay, now though it's October 22nd, so it's later down the road, and we're actually receiving the very thing that we expected to receive on October 22nd. So what we're going to do here is our cash is going to go up by 1,400, but our accounts receivable, this is very important, our accounts receivable is actually going to go down by 1,400. Why are we doing that? Let me take the time to explain that. Why are we putting cash up and then we're putting accounts receivable down? Well, the reason why cash is going up is because that's what we receive. But the reason why accounts receivable is going down is because what we're saying is we no longer expect them to pay us back. So let me put that here. Some people learn by audio, some people learn by visual. So I want to make sure I'm covering my bases. So let's put that here. So when we receive cash for what we expected, we will decrease what we said we are expecting. Okay, so very clear language, right? When we receive cash for what we expected, because remember on October 2nd, we said we expect 4,000, or excuse me, 1,400 later down the road. Well, we're here on October 22nd is later down the road, and they actually paid us back. So when they pay us back, or when they are paying us back, then we're going to decrease our expectation. Remember, expectation equals expectation equals accounts receivable. Okay. So whenever I say expectation, think accounts receivable. So we're going to reduce our expectations. So we're reducing that by decreasing it for 1,400. You're going to then say, but Dr. Akin, I understand that. But what do we do on this side? Because you said, Dr. Akin, whatever we do on this side, we have to do on that side. But here's the truth. Here's the truth. If this side is a positive and this side is a negative, what does that equal? It equals donut. It equals zero. Let me put it over here. Okay. There we go. It equals zero. Okay. If we put a plus 1,400 and then we put a negative 1,400, that's going to equal zero, right? Because look, 1,400 minus 1,400 is zero, right? So if this totals up to be zero, then that means we don't need to do anything here. So we can leave that as zero. You see? So I know that that was a little tricky. Let me know in the comments any questions and I'll respond in the comments. Okay, but we got to move on. So October 20th, the company paid 1728 cash for advertisement. So we're going to come here again. We're going to put a negative because we're paying. So money is coming out of our bank account. A negative 1,728. Okay. And whatever you do on one side, you do on the other. Our expenses is also going to be a negative 1,728 as well. Okay. And we are done. So moving on to the next one, October 17th, it looks like cash to repair its computer equipment. Okay, so we paid again, so money is leaving our bank account. So we know on the cash side, we're going to put a negative 10 or 805. And on the right side, we're going to put a negative 805. Okay, whatever you do on this side, do to that side to balance. Okay, so let's move on. The next one, very, very important. On the 15th, the company received. So now we received cash for services performed. Or excuse me, what are we looking at? The 15th. The company received 4,800 cash from Easy Leasing as partial payment. That's very important towards its account. Towards its account. So in this case, for the 15th, it's going to be the same situation that we did here. We're going to increase our cash. So we want to put plus 4,800. And just like the other one is not going to be revenue. So that was a mistake there. It's going to be accounts receivable, right? So accounts receivable is going to go down the same 4,800. Okay. Why are we doing that? Again, because we said early on October 6th, we're billing them. So we're expecting to receive 4,800 later down the road. Well, it's October 15th, is later down the road. So they gave us back the money they owed us. So what is accounts receivable? Money they owe us on credit. So we receive the money, so we increase our cash 4,800, but we decrease what we expect, what we said that they were going to pay us back, which is 4,800. So again, if you do the math, 4,800 minus 4,800, that's going to be zero. You see? So if we have $0 value here, so the dollar value here should be zero as well. So we do nothing. Okay. So hopefully you get the concept. Let's do October 12th. The company billed Easy Leasing another 1,400 for services performed. So we build, right? So again, our expectation is that we're going to receive the money later down the road. So we're going to come here and put a positive 400. So we're increasing our expectation that they're going to pay us later down the road. Okay. So now if we build accounts receivable for 1,400, whatever we do on this side, we have to do on this side. So we're also going to increase our revenue for 1,400. You see? And that's it. Whatever we do on one side, we do on the other side. All right, let's keep it moving, please. Put a thumbs up if you understand this or you need me to explain something. Put it in the chat and I'll reach out and explain. All right, October 8th, the company paid again. So we're losing money. So we know that we're losing money, cash for computer supplies. So here's the interesting thing. Although we're losing money, we're actually gaining supplies. So let's work this out. We're losing money, so we can put a negative 1,420 in here. We're losing money, right? But we're also gaining computer supplies, right? So we can come here and put a plus 420 here. Okay. So here's the thing. Here's the thing though. It says we paid cash for what we purchased on credit. You see? So we paid cash for what we purchased on credit. So this is kind of trickery because although we're gaining computer supplies, we actually don't need to record here that we gained computer supplies. All we need to record here is that we paid cash, right? We paid cash for our bill. We paid cash for our bill. Okay, so we're going to put 1,420 in here. So let me explain to clarify. Okay, so it says on October 8th, we paid something that we promised to pay back. Because remember, if we look on credit, let's look at our note. What does credit mean? What does credit mean? Credit equals accounts payable. Accounts payable equals money we owe them on credit. So again, when we purchased computer on October 3rd, it looks like we purchased some computers and we used it on credit. Meaning, remember we said there's two sources of payment. It's either cash or accounts payable. In this case, it's accounts payable. Okay, so what is accounts payable? Money we owe them in the future. Money we owe them in the future. Well, it's October 8th. The future is here and we're paying our bill. You see? So when we're paying our bill, right? All we need to account for is the cash for 1,420 and the accounts payable for 1,420. So our cash is going to go down, and what we do on one side, we have to do on the other. So we're going to go ahead and reduce our accounts payable. What we said that we're going to pay them, we're finally paying them, so we're reducing that by 1,420. Okay. All right. Cool. It looks like I actually skipped October 6th, so we'll do that all together. Okay, so October 6th, on October 6th, it says the company billed Easy Leasing 4,800 for services performed. So we billed them. So we're gonna come here and put accounts payable here. I didn't skip it, but I just put it on the wrong one. So accounts payable is gonna be here, and then revenue, right? Because it doesn't matter when we receive the money, it is considered revenue because we perform the work, right? That's what we put in our notes here. When work is performed, we are immediately owed the money. We do not wait to receive the money to say that we are owed the money. Services performed equals revenue. So that's what we have here. So billing and revenue. So in this case, what's going to happen? Our expectation is going to increase. So we're going to increase the fact that they owe us money. or they are expected to pay us back later down the road. And then we're also going to increase the fact that money is coming in. You see? So we're going to increase our accounts receivable 4,800, and on the other side, we also have to increase it for 4,800. Okay. October 3rd, we purchased 1,420 of computer supplies on credit. You see, remember there are two forms of payment. The first form of payment is cash or is credit. So we're doing credit here. So, okay, what's happening? Computer supplies is going to go up by 1,420. Okay, it's going to go up because we're gaining computer supplies. Now, what we owe them is also going to go up, right? Our tab or our bill is going to also go up. Accounts payable, remember, is what we owe them. Okay, what we owe them. We talked about that earlier. What we owe them. So that's also going to go up. So we're going to go ahead and increase that. So let's do that. Plus, let's go ahead and plus increase 1,420. Okay, and then last but not least, and we're done for today, invested. So, okay, now the owner invested in multiple things. They invested cash. So, what's happening for the company? Is cash going up or is it going down? Cash is going up. So, let's go ahead and do this. We're going to increase cash by 4,000 or $45,000. Computer equipment, they're gaining computer equipment. That's going to also go up by $20,000. So, we put plus $20,000. And then last but not least, office equipment, that's going to go up as well. We're going to do that. Okay, we're going to increase. So we put plus $8,000, right? So now what we do on one side, we have to do to the other. So the question is though, what in here speaks to the other side? Well, it says this word common stock, common stock. Okay, remember we talked about this earlier, but common stock is ownership into the business. So it's not a liability because that doesn't speak to ownership, but it is an equity. So we come here and put common stock. Now, whatever we do on one side, we have to do to the other side, and it must what? Balance. So we have to do 45 plus 20 plus 8. So 45 plus 20 is 65. 65 plus 8 is going to be 73. So we come here and we put plus 73,000, and that's going to balance, right? So that's it, guys. This is how we do the accounting equation. If you have any questions, please make sure to put in the comment section. If this was helpful, please make sure you like this video. Please make sure you subscribe to hit the bell notification for more videos. And please make sure you share this with your friends so they can benefit as well. Thank you so much. Have a good day.